Good morning, everybody. Paul here coming at you with a Crypto Coffee update where we talk about all of the news, events, and happenings in the exciting world of decentralized finance, all while enjoying our fresh cup of coffee. So join me, if you will, for a simultaneous sip. Cheers. The sip heard around the world. 2 orders of business before we jump into the meat of the matter and the exciting news of the week. I have been MIA for the last week, you probably noticed. That is because my wife and I actually run a homestead. It sparks me tremendous amounts of joy to go out there and work on the garden and work with the animals that we have, and it's just something I really love to do. So it's been incredibly busy now that some of our perennial crops are coming in, and we're getting all of the annuals planted as well, winterizing sprinkler systems, etc. So that's taken up a huge chunk of time, and as well with the harvest season, going to be doing a lot of canning, pickling, etc. So that's where I've been, and let me know in the comments below what gives you joy in your life, what sparks you the most pleasure and joy, and what kind of lifestyles do you lead. There's no two people that are exactly the same, so I'm curious what you guys find enthralling, of course, other than the wonderful space of decentralized finance and blockchain. Second order of business that I wanted to touch on, check out this sweet shirt that me and the guys over at Smart Cash designed together. Fantastic design. Huge shout out to the guy who put this together. Really great stuff. And on the back, a rising Cryptide lifts all ships. That is, oops, it's this way, isn't it? There it is, thumbs up. Good stuff there. Left to right, right to left with this camera. But yeah, so fantastic stuff. You can pick that up over at the Smart Cash shop, which I will link below in the description. All right, so let's get into the news, which you're all here for, the tasty tidbits of happenings. The crypto exchange Binance has revved up the old engine yet again on their exchange after a unfortunate $41 million hack, something that ultimately will not affect users thanks to the Seifu Fund. CZ inceptuously created this insurance fund for just such an event, and luckily it seemed as though the PR fallout was minimal until he talked about rolling back the Bitcoin blockchain. You got to give the guy a little bit of credit, perhaps. He's under a lot of stress, especially given the circumstances. And all in all, that did not materialize. We talked about that in the last Crypto Coffee update, and it seems as though the one caveat is withdrawals will be open shortly. This was 2 days ago, so no word as to whether or not withdrawals are currently open. I personally really don't use Binance, so if any one of you out there do, let me know below in the comments if Binance has reopened withdrawals. But point of the matter being, things are starting to normalize again. Binance is absorbing this loss, and better safe than sorry in terms of withdrawals. No word as to how that's going to affect the Bitcoin price. You can see here on the side of our screen at time of recording, it's crashed down to $7,300 from a whopping above 8K. We'll talk about that here momentarily. Point as well is that things are not always rosy for crypto exchanges. Cryptopia has begun liquidation after suffering a perhaps comparatively paltry $15 million hack, if 15 million could be considered paltry, relative to Binance definitely, but proportions are everything here, and this was enough to kick the exchange into liquidation, and you can see they've appointed Grant Thornton. So this is the kind of thing that takes a long amount of time. Quote, "We realize Cryptopia's customers will want to have this matter resolved ASAP. We will conduct a thorough investigation, working with several different stakeholders, including management and shareholders, to find the solution that is in the best interest of customers and stakeholders." If you try to go to Cryptopia's website, you are greeted with a very similar greeting talking about how Grant Thornton has been appointed for liquidation. And again, this is something that's going to take time, perhaps even months, maybe even a year or two. There's no real definitive time frame yet. They have to do all kinds of auditing and see what is on the books, what is now missing due to the hack, and ultimately how some form of restitution can be delivered to Cryptopia exchange users and shareholders alike. So best of luck to everybody out there involved with this. It's never something that we want to see, and a great example of why having cold storage is super important for exchanges, specifically for their proportional funds. In the Binance hack, only 2% of their total funds were even exposed, and not even that much got taken. So really, proportionally, was not that big of a hit. And this goes for users as well. For you guys out there, this is why using an exchange as your primary method of storing your funds is not a good idea. There's plenty of good cold storage solutions out there. Just some off the top of my head, we have Trezor, we have Ledger. We also have the fantastic Elapal, which if you checked out the Smart Cash video that I did for them, we do a review of the entire hardware and software component on your mobile device. So plenty of options out there on the market, none of which I particularly prefer per se. I may be a little biased just because I've used many of these, and there's some I haven't used, so I might prefer some over the other. But hey, any solution's a good solution, especially when you minimize the risk of potential loss of funds. So that's something to consider. Speaking of loss of funds, here's Tether yet again. They received an order from the New York Supreme Court to freeze transfers to Bitfenix. Now, this may seem like it's escalating a little bit, but there is some silver lining for Tether and Bitfenix, both of which, by the way, are owned by the same parent company, Bitfenix, so something to keep in mind. Specifically, the judge ordered that Tether cannot loan any assets to Bitfenix or any other parties except in the normal course of conducting business. They can't distribute any funds from its reserves to executives, employees, or individuals except for payroll and normal contractor, consultant, or vendor payments. Neither Bitfenix nor Tether are allowed to modify in any way documents asked for in the NYAG's original subpoena. That one kind of makes sense, just straightforward. And number 4, the injunction will expire in 90 days, but the NYAG's office can petition the court to extend it 2 weeks before then. So while this only will last allegedly for 3 months, there's no way to know if extensions will be granted, and they can kind of do it close to the last minute relative to the total time frame. So they're NYAG here is basically saying that they want Tether and Bitfinex to behave more like a normal business in terms of U.S. regulation, and also to cease some of this shady activity, and also divulge some of these documents that may shed some more light onto exactly how this money is being moved between these two entities. And here's a quote from Bitfinex. They're praising the judge's decision, saying, "We believe that the court's decision today leaves no doubt that both Tether and Bitfinex are entitled to run their businesses in the ordinary course even during the short period when this now narrowed preliminary injunction is in place." So it seems as though that Tether, Bitfinex, kind of the same entity, can invest their capital as they see fit from their reserves. They just cannot distribute it to executives, employees, or other individuals outside of payroll, and also must bring forth those documents previously requested by NYAG. Now, a potentially shady move, I don't want to say shady to kind of frame it like that, but a move that ultimately from NYAG's perspective will look a bit strange is the fact that Bitfinex as well launched a exchange token with no particularly clear utility. Perhaps individuals who own this are indeed people who have licenses to own securities, because one could only imagine that if you were deriving profit from the activities of Bitfinex, that is indeed failing the Howey test. That's a security, at least in the US. But they're going to launch this on their new exchange token. They're going to launch it on Bitfinex starting on Monday. So we're going to see exactly how the price action goes. They did it to make up for the 850 million shortfall in funds. So one has to wonder to what degree that is a wise business decision to go ahead and issue an asset like this in order to raise short-term capital. I'm really kind of on the fence about this. Let me know what you guys think below in the comments. Was this an incestuous move by Bitfinex to kind of accentuate their longevity and raise capital where needed, or is this kind of a breath of fresh air, keeping their head above water as the waves begin to kind of move over them? So, I mean, who knows? In addition to our excitement around bringing such an unprecedented and powerful token to the heart of our community, the Bitfinex team remains dedicated to continuing to grow and develop core infrastructure for the industry as a whole. Again, definitely kind of head-scratching stuff. They raised almost $1 billion USDT from this, so going to be interesting to see how that plays out. We'll keep you updated as things move on. Like I said, we've covered the Bitfinex Tether saga extensively here at Cryptide, and I'll put some links below in the description that you may find interesting on that subject. So moving along, Bitcoin and Ethereum, as we talked about earlier, plunged in terms of price. They were all the way up to about $7,800 to $6,700, so a huge drop, and this is because a major sale of Bitcoin on Bitstamp triggered some leveraged positions on BitMEX, leading to liquidations and of course a downward pressure on price. You can see here, oh, this will take us to Twitter, but that's just okay. There we go. What am I doing? All right, there we go. You can see the price crashing down from 84.65 roughly is here, so it was around 8,300 or so, and just broke through this floor all the way down to 6,300. And the price hasn't quite recovered since, but nonetheless, I heard someone say it, we took the stairs up, we took the escalator down, that's for sure, or the elevator down rather. So just something to keep in mind, kind of cascading stop losses that can occur in these kind of situations, especially as you have extremely leveraged positions out there. So yeah, a whale crashes the entire crypto market 20% in 5 minutes with a single sell order on the books, and people actually think an ETF is coming. That is another thing we'll be talking about here momentarily. An ETF is potentially in the works, but before we have any kind of ETF, we definitely need some guidance. And lucky for us, the FinCEN over here in the beautiful US of A issued some guidance on how AML regulation applies to the crypto market and the blockchain industry as a whole. So this is really encouraging to see. Again, this is not new legislation. This is just guidance that summarizes the plethora of information that's came out. Here we are with Jake Chervinsky. He has some great summation of what happened. He's breaking it down into some winners and losers. They're not clear winners and losers. This kind of guidance applies differently to existing entities, depending on where they fall and kind of what flavor of business they're undertaking. But just to keep it simple, there's winners and losers. The biggest winners are dApp developers, individuals that build applications to facilitate transfers between individuals. They are kind of, I don't want to say scot-free, but they definitely got the better end of the deal in terms of they are not individuals that handle money transfers. They are simply the facilitators of a service that is an application. So they kind of got the better end of the deal here. The individuals who did not get so great of a deal are the P2P lenders. So we're talking local Bitcoins and other over-the-counter peer-to-peer kind of services that are not currently regulated in terms of having a license to do so. So while previously this was kind of in a gray area, it seems as though now FinCEN's guidance suggests that individuals who indeed facilitate such services like local Bitcoins, that is something that is ultimately going to require a money transmission license. And of course, we've already seen local Bitcoins move more towards KYC and AML regulation for that precise region, our region, US. So yeah, definitely great stuff there. FinCEN's comprehensive guide to crypto from Catherine Wu. She is fantastic. We've checked out some of her stuff on a previous Crypto Coffee update. You can download the guidance here, which we have done. And you can see this is not legal advice. Start on page 14 if you want the good stuff, which we will do. So we'll scroll on down to page 14. Whoop, there we go. So here it is. Such forth examples. I know, give me the great stuff. Finally, we're getting some regulatory clarity here. P2P exchanges, as said, peer-to-peer exchanges are typically natural persons engaged in the business of buying and selling CVCs. Ultimately, this is, unless you do this for free, and very rarely, you are subject to BSA regulation. So that is something to keep in mind. And this also includes crypto ATMs. So this is going to get a little dicey in terms of crypto ATMs. They already have to have legal guidance and all that sort of stuff. And generally, it's suggested you get a money transmission license before even opening one up. But this really kind of lays a much more clear line that you will indeed need a money transmission license to do so. So as said, this is the annotated from Catherine Wu version of the 33-page FinCEN guidance. We're not going to go into it in its entirety. That would take a long time. But of course, as usual, guys, links below in the description for you all to peruse at your leisure, since citing your sources is so important and something that I don't see enough in this blockchain space. Moving right along, the ETF we mentioned earlier is delayed for another 5 weeks amongst concerns from the SEC, perhaps in part due to the recent upward and downward movements in the crypto price, but the SEC definitely is a lumbering giant of regulation, so perhaps such timid movements in the price doesn't cause them to bat an eye, and really they're more concerned about the stability of the market. We've talked previously about Bitwise. The Bitcoin trade volume analysis that they've given to the SEC shows that 95% of volume is indeed fake, which is bad in a way, but also is good in some senses, in the sense that the futures contracts are materially significant volume relative to the spot volume of Bitcoin, which means it's becoming a more mature market. An ETF could perhaps absolutely explode the exposure that individual investors can have to Bitcoin in a regulated fashion. Of course, this kind of runs contrary to the not your keys, not your coin mentality, but as a emerging digital asset, a class all its own, really, individuals are hungry to get exposure to Bitcoin in any way they can, whether that's through a custodial relationship, buying directly, or, as we see here, the much fanfare surrounding the ETF. But again, following the May 7th Amendment, their ETF application, the Securities Exchange Commission has delayed making a decision for, as said, another 5 weeks. A quote from the SEC: "It is a mechanism that allows the SEC staff to gather expert input from the public on specific issues surrounding various proposals while extending the statutory time period within which the staff is required to either approve or disapprove the request," said the representative from Bitwise to CryptoSlate. My bad, that's not the SEC, it's Bitwise. So this is Bitwise explaining what the SEC is doing. They're basically looking under the hood even further. That's what they've been doing this whole time, but there's a lot of information to intake, guys, just like here in the crypto news realm. A lot to chew on, but suffice to say that this is something that has been in the works for a long time. Individuals are excited for this, and as well, the huge custodial service known as BACT, which is owned by the Intercontinental Exchange, which also owns the New York Stock Exchange and stock exchanges all around the world. So slowly but surely, we're seeing institutional investment kind of seep into the space, and the strong pillars on which a foundation for greater investment and vehicles for investment are being laid are just now emerging. So exciting stuff here. Now, also interesting enough, MakerDAO finally decreased their fees. The fees were as low as, I believe, 0.5%. I don't think they ever hit 0.25%. They were 0.5% for a while, and for the first time in 5 months, they've now decreased. They popped all the way up to 9%. 19.5%. Dang, I'm telling you, it goes so quickly. Definitely sparked some outrage, as you can see, from early borrowers, but now it's gone down a little bit. But I think the main focus here is this is decentralized finance, but ultimately participation is a huge issue. It turns out, according to Brown, only 2 MakerDAO token holders voted for the 2% decrease, collectively staking 54,000 Maker tokens. What's more, and perhaps a bit worrisome, MakerDAO token holder decided to troll the system and staked 17,000 Maker in favor of a further increase, despite the clear overvaluation of DAI in the market. As you can see here, the price of DAI went from 99 cents and ebbed on up over the months all the way up, or over the days, all the way up to about $1.06 when it's supposed to have a peg of $1. So that's what the stability fee helps to facilitate. Is just that, stability relative to the US dollar. And this is worrisome considering that one individual was able to put 17,000 Maker to troll the system, and only 54,000 from 2 individuals is what ultimately led to the devaluation or decrease of the stability fee. So this helps to highlight incentives in a system, of any blockchain system. The fact that individuals who hold the most Maker tokens are disproportionately incentivized to vote regularly and interact with the system. For example, if an individual held only 50 Maker tokens, then they would really have very little incentive to be so astute and attentive to these stability fee adjustments, because their stake in the system is comparatively low, whereas someone with 17,000 Maker, maybe they're just having a good time, and there's no real way to know or ascertain this individual's motives. One thing that's been said is in all systems you have to account for rational actors, but you cannot account for irrational actors because their actions are just that, irrational. We desperately need people to lock up their Maker tokens, said Brown on today's call. It doesn't take a lot for another voter to come out and outweigh the on 17K Maker troll that was trying to raise the stability fee by 4%. I think a bit of a typo there, but that's okay. The gist of it is definitely understandable. So if someone has that capacity to troll the system, that's not good for the ecosystem as a whole, and really that's just some implications to be taken from there. The peg does remain intact, so something to consider, and MakerDAO is a fascinating service. If you want to learn more about it, I'm going to link this article and a bit more below in the description so you can check it out. All right, moving along. Speaking of incentives in a semi-centralized system, this is something we've talked about extensively here at Cryptide in terms of the delegated proof of stake, a system that delegates stake and ultimately leads to a kind of creeping centralization in a lot of cases, just simply because that's how the government's model ultimately incentivizes behavior. We've seen it in part a bit on EOS and a bit on Tron. That's not to say they're bad systems, not to say they're bad blockchains. It's just part of the governance system that's been set forth, so something to consider. However, on Tron, they've definitely gotten the more negative kind of light, considering that Lucien Chen, the former chief technology officer and co-founder, said Tron is no longer decentralized. During 2 years of Tron, he felt the wheel of destiny turning rapidly, and he also went forward under the drive of that wheel in his efforts to form the domestic team and all the coding from scratch, which is not the case. They actually just forked the Ethereum J library, so I don't know what's going on here. And the currency began to soar from ICO until now. Looking back on the past, it seems like a dream. It's all gone through stages of open source, testnet launching, mainnet, the acquisition of BitTorrent, ecological expansion of the Tron DApp, from stealing white papers to borrowing code and removing the license that was on that code. A lot of hard work. Kind of being a little harsh here towards Chen and the Tron team, but ultimately that's what happened. So saying that it was extremely hard and they built it all from scratch is just frankly demonstrably not true. But that's neither here nor there. Really, the interesting part is the CTO is himself saying Tron is no longer decentralized, if it ever was to begin with. In DPoS, the delegated proof of stake that we just talked about, and super representative node, there's a problem of centralized voting. Some nodes have more than 90% of the votes with only a few voters. Therefore, the votes of ordinary retail investors has completely fallen. Again, like we discussed previously, it's basically rendered inert due to the lack of incentive and due to the proportional incentive of larger holders. The total number of TRX and Tron is 100 billion, while the total number of votes for super reps is less than 8 billion, so only an 8% turnout. Keep in mind, EOS required a 15% voter turnout to launch their mainnet, and they had a really hard time initially getting those individuals out there, but luckily they were able to get over that hurdle and things were able to launch properly. But now you can see Tron in their delegated proof of stake system, only 8% of voters are turning out. And again, keep in mind that incentive structure, guys. If you have a disproportionately large amount of tokens that you're holding, you are more incentivized to participate in such an ecosystem relative to an individual who does not have nearly as much stake in the system. And of course, Chen says, I'm deeply sorry to see the project that has grown up in my hands become like this. The dreams and visions that Justin told me have been ruined. After several months of thinking, I decided to start the Volume Network project. So of course, yet another ICO happening, guys. That seems to be the lay of the land for these sorts of things. But we'll see what happens. Maybe they won't do an ICO. I mean, only time will tell. But given the meteoric success of Tron, I'm sure the sweet allure of that much capital will be hard to stave off. But really, best of luck to Lucien Chen. We need all the help we can get in the blockchain ecosystem. I don't want to call it a fly-by-wire kind of system, but hey, experimentation is how we find out what works, what doesn't, and where these things may be applied. And that's something we want to keep in mind from a 50,000-foot overview, because when we get lost in the weeds, and I've been so fortunate to experience so much of this industry, when we get lost in the weeds of what this might be applicable to, we ultimately, especially in the voracious manic nature of the bull market, we overextend what blockchain is applicable to in general. So I'm over here, this is page 4. This is from Cambridge. This is Distributed Ledger Technology Systems, a conceptual framework, a 97-page analysis from Cambridge University, and it breaks down. Michael Roches is one of the primary authors, great guy. Follow his stuff on Twitter, his great insights. And this talks about the difference between exogenous and endogenous references in a blockchain system, page 48. This is critical and something that I do not see enough in this space. People talk about all the time tokenizing real world assets and just creating value networks, and the difference between those two is immense, and I don't think it gets nearly enough attention considering exogenous resources being tokenized is a mammoth of a task when compared to endogenous resources. So let's scroll down briefly to page 48 just to cap our conversation here and talk about just briefly the differences between these two before we part ways. And I'll link this, of course, below in the description so you as well can read through this at your leisure and get some great information. So exogenous and endogenous references. Records may reference endogenous data and or exogenous data. Endogenous data is information that comes exclusively from within the core system. Think Bitcoin. Bitcoin does not correspond to any external stuff. A Bitcoin's a Bitcoin's a Bitcoin, and it only references the unspent transaction outputs within the system itself. It is self-contained. Now, there could be an argument that, well, there is a proof of work involved, and yes, there is, but that is not explicitly related to the what the ledger is attesting to and what it is interacting with. Exogenous data refers to data that tracks information about the same entity or a relationship that is external to the DLT system. So we're talking lettuce on the blockchain. That is an exogenous system, and it tracks anything that is outside the blockchain system. This presents unique challenges, guys. That was my dog. It presents unique challenges, guys. Think about this. If you are putting something that, let's say, fine wines, which VeChain wants to do on the blockchain, you still have to have minders. You have to have individuals who are individual points of failure that are trusted entities to ensure that maybe you're just walking by with an RFID chip and it's not necessarily attached to the bottle of wine. Well, the blockchain doesn't know that. It has no ability to discern whether or not this is a legitimate log on the distributed ledger, or whether or not this is something that is a spoof that is being undertaken by an individual who is allowed to attest data to that distributed ledger. So this is just a, like I said, 50,000 foot overview of these systems, and absolutely something to consider if you or anybody you know wants to implement a blockchain. These are important components of consideration for how you may want to build your system. After all, as I said, delegated proof of stake is not a good or bad thing, because when you have a system that is dealing with exogenous assets, you're going to need some individuals that are delegated with a certain level of authority that are, in a way, trusted to assure that the information being attested to the chain indeed corresponds to the reality of the situation on the ground. So that's a unique problem that VeChain and other blockchains dealing with exogenous assets are going to be dealing with, and those that deal with endogenous assets, such as smart cash, for example, they're not dealing with that particular problem, but they have unique issues all their own that they interface with. So just some interesting stuff. Again, Cambridge paper here, guys. Wonderful paper. Absolutely recommend reading it. Put it below in the description. But yeah, that's all we have for the day. Thanks so much for being here with me, guys. I absolutely love the time we share together. As I've said, been very busy with the homestead, but if you're on the Discord, I'm a bit more active there, kind of pop in and out and share some news and fundamental stuff that I check on the daily. So yeah, expect some crypto coffee updates as well coming down the pipe in the next couple days, perhaps even a week, depending on how busy things are. But nonetheless, much love to all of you. Again, let me know what gives you the joy in your life below in the comments. Look, always enjoy interacting and hearing from you all. Thanks again for watching. My name is Paul. We are Cryptide, and remember, the tide is rising, as is the Bitcoin price, guys. Is it a bull market?